Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are recording remotely. We are actually in the offices of JPMorgan Asset Management, and we're joined by one of the heavy hitters from JPMorgan Asset Management, Kerry Craig. Welcome back to Equity Mates.
Thanks for having me. It's a pleasure to be with you guys again, as always.
Now, Kerry is the Executive Director, Global Market Strategist here at JPMorgan Asset Management. And one thing that you do every year, Kerry, or you and the team globally do every year, is your long-term capital markets assumptions, where you look forward 10 to 15 years and project how asset classes, not just equities, but fixed income, private equity, property, infrastructure, how they're all going to go over the next 10 to 15 years. And so in today's episode, we're going to look into your crystal ball and unpack where our portfolios are going to go over the next decade. But before we do that, we want to start short term because so much has happened since we've last spoken. And really it starts in the US and really the conversation starts with Trump. So let's start there. You have the fun job of trying to forecast how his administration and his policies are going to affect the market. And that's, I guess, really a two-step process. First of all, what will actually be implemented? And then secondly, what are the consequences of those policies if implemented? So let's start at a high level. How are you projecting the next few years and the impact of the Trump administration on markets?
I mean, when you look at how the markets have reacted since the election, there was a clear indication that it hadn't been fully priced, right? We saw bond yields go up a lot around inflation expectations and the change that we saw. We've seen parts of the equity market rally quite strongly on impacts around deregulation and what might come through. And we've seen other parts of the world, take a bit of a more negative turn around tariffs and what might come through on that side of things. Right now, obviously, we can look forward over the next 12 months and say, well, we know these things are going to come. We're not exactly sure the scope and magnitude of what they will look like, but we can take a broad sweep and say, on balance, these things are likely to create, more growth in the US because they're very much American first policies. They're more likely to create a bit of a downdraft to growth in other parts of the world. They're going to change how central banks respond currently to what we thought they were going to do. So obviously, if there is that idea around less growth in the rest of the world, central banks are probably going to do more in terms of easing. If it's a case of more growth and perhaps more inflation in the US, it means the Fed's going to do less, and that's going to have a big impact on how stock bonds move and what we've seen priced by the market. But by and large, it is going to be a case of thinking around, is US exceptionalism here for another year? And it is going to be a supportive market for thinking about equity returns, and those returns in the US getting a little bit more broader in terms of moving out across the sectors beyond just those big growthy names and into some of the smaller mega cap, away from mega cap and into some of the mid cap names. And then looking around the world to see, well, there's going to be still alpha opportunities and countries that do quite well. Where are the ones that are going to be resilient to some of these policies? There is still that theme around supply chains that's going to help countries like Taiwan and Korea that can benefit from that. There is the concerns around Europe and what that means for growth, given the trade relationship with both the US and China. But that's the place you go for duration. You do see further rate cuts. So it's a bit more around balancing that idea that we're not heading for a recession in the US. That's going to have a big impact on the way we see global growth, but we have to be more nuanced in terms of thinking about the asset allocation and portfolios. Still risk on if we have positive growth, but balancing that out with duration. That duration is probably not going to be in the US. It's going to be elsewhere in the world.
In terms of specific policies, though, you mentioned tariffs. He has pretty strong views on deregulation, tax cuts. What are you specifically watching? What do you think will have the most impact?
Well, it's really around the sequencing of how things come in. So we first look at what can the president do autonomously? What can he actually change straight off the bat when he gets in on day one, and what sort of executive orders can he put through? That really comes back to things like trade policy, tariffs, immigration. Those are the way you could see early changes that could be reflected in the market more quickly. Anything that requires big spending changes is going to have to go through Congress. That budgetary process happens near the end of the year. So when we start to think about the extension of the Tax Cuts and Jobs Act or anything like that, that's really something that's going to feed into end of 2025 or actually more likely affect the market in 2026. So the biggest concerns around how the policy dynamic could play out is that sequencing. And when it comes to tariffs, if we take what the president-elect says at face value, we should expect to see big tariffs being applied to Chinese goods. the question is, not everything that wants to come into the US can be substituted from somewhere else. So it's then again, like, is it going to be focused on goods where there's no competition in the US, where you can actually see those tariffs, hit that 60% level? Is there going to be a lower level of tariffs with things where there isn't that substitute ability and feed into the manufacturing process in the US that is still required? And then obviously thinking about that level set change and how that impacts inflation depends on whether we get these big one-off changes in tariffs or if they're fed through over time. So if it's just a one-off change, that just means prices change once. The inflation impact is just one step higher and then it goes away because the prices aren't changing all the time. Federal Reserve looks through that. They don't really think about that in their policy setting. If it's a consistent change, then that becomes inflationary over time. The markets will adjust for that. So tariffs migration are probably earlier up the list in terms of what the market's going to be concerned with. And then that fiscal policy side, some of that deregulation may come a little bit later. And I think it's really about saying we want to wait and see what the economic data does over the first, couple of quarters in the US. And that's where you really start to see the economic impact come through. However, markets forward looking, they're going to start to price that as soon as now, and then obviously as we get closer to that inauguration date and hear more around what that actually policy dynamic could look like.
What we're seeing now is a number of cabinet appointments being made and staffing appointments, and people are trying to look through those and understand what that will mean in terms of policy settings. Treasury Secretary hasn't been named yet, but that's probably the big one for the economy. How much attention are you paying to the people that Trump is nominating and their views?
A lot. I mean, it does make a difference in terms of they're the people that implement his agenda, right? They're the people who are going to take his actions and actually put them into place in the economy. And so if they do have, say, like tariffs or trade, if they do have that very hawkish view against, say, China in terms of what tariffs should be done, that does skew you towards thinking you're going to get more of what was discussed on the campaign trail rather than less. That you'll get, less of a pushback by advisors around maybe this isn't so great for the US economy because, it can have that negative growth effect. So it does just start to think about how that could actually mean that the policies implemented do look more like what was discussed, rather than having the assumption that, these things get watered down because of different people's views, and that's how politics goes. And so that just skews the policy dynamics more to the perhaps extreme end of what could have happened rather than the middle ground to a certain extent. But it shouldn't detract from the basis that a lot of these things are going to help growth in the US. They may create some inflation, and broadly they're going to support the earnings outlook. So, it shouldn't make you shy away from US assets and US equities, given even they have run quite strongly.
So we sat down with you in Feb this year, I think, and you were pretty confident that the US was going to cut rates towards the end of the year, which has certainly played out. How do you see that progressing through 2025, pace of cuts and timing?
I mean, that's now the market is pricing out rate cuts in a big way in the US, right? So really lowered the expectations for even a rate cut in December, and then seeing, I think, less than 50 basis points now priced for next year in terms of Fed action. And I think the Federal Reserve has been pretty open when you look at what Jerome Powell has said lately around, we don't take the promise of policy into account or what could happen. They're not looking at the ifs. They want to really see what happens and how the market evolves in terms of the economy, evolves and the data that comes out. So I think if you look at what's going to be driving the Fed in the next few weeks, it's obviously the non-farm payrolls and the labor market data, and then the inflation numbers. If those a surprise to the upside, then you can just really take off a December rate cut and the Fed moves into more of a pausing cycle. Our view is that you'll probably get one more in December and then a couple of rate cuts over the first part of next year. At that point, you'll have a pretty good read on where inflation is going. If it's going to be sticky, the Fed really starts to go into an extended pause cycle there. So you're only really seeing rates come down 75 basis points. Now, think about what the Fed said back in September. They had their statement of economic projections. They were fully pricing in sort of 125, if not more, in some views of Fed committee members of rate easing. That very much feels like it's off the table now. So you may be getting back down to 4.25 on the Fed funds rate, potentially less. And so that's a big implication for thinking about where bond yields are going. The bias does seem to be to the upside at the moment. So how much duration do you want to add if yield's going to rise? And then thinking about what that means for the valuations on stocks. So longer duration stocks, if yields rise, could be feeling some pressure around those valuations. Or is that, downplayed by the fact that you still have good earnings growth in those growthier parts of the market, which are going to be supportive of thinking about positive equity returns? So our view is the Fed's going to do less than what we thought a couple of months ago. I don't think they'll move far as rate hikes. There have been some people calling for that, but it's more likely a few more rate cuts moving into hold. And then when they get to 2026, really assessing what's the outlook in terms of, is it the end of the cycle and we should be thinking about greater rate cuts and growth risks, or is it going to be a higher for longer where inflation's going to be sticking around for a bit longer, and so you just get persistently higher rates overall?
So how about Australia? We had the Reserve Bank commentary from the November meeting, or the minutes of the November meeting get released, and all of a sudden a lot of the major banks and forecasters who were saying we're going to see a rate cut in February said, oh, actually maybe it's going to be May, and who knows if that continues to get pushed out further. Where do you see Australian rates going?
Yeah, I think there's an interesting comment because in the minutes they basically said we need to see more than 1/4 of inflation coming down to really cement our views we should be cutting rates. Personally, I think that was just them saying we know this quarter inflation is going to be too high, and we also know that there's the impact of subsidies that are impacting these inflation numbers. So we generally don't think that's the right place to be cutting rates. So I think it was more pushback against what you're going to see in the last quarter inflation numbers that come through, rather than them thinking they need to see like inflation coming down over the first quarter of next year and the second quarter of next year. So on that basis, we still think that there is potential for them to cut rates in February. Obviously, they're looking around the world just as we are and thinking, what's going to happen with tariffs? How much could that create a headwind to Australian growth? What will China do in response? Will there be a big stimulus, which would be positive for the outlook here? And really trying to probably wait and see what happens on that front. So, the bias is to say they do move later, that they have that uncertainty and they do know that underlying inflation is still too sticky in Australia, that the unemployment rate is still very low, but stabilized at, a number that's lower than probably they would have liked. And so there is, some sensitivity to that. So our base case is still February, but I could see that being pushed out into after the election, just given that uncertainty that's sitting around. And I think the real risk here is that given what happens in the US, that perhaps the RBA just can't move on rates. They just don't get the opportunity to ease those policy rates. And then that has, some economic consequences. We think about the drag from those higher rates on the economy over time.
So there's 1,000 things for us to focus on. Sometimes it can be incredibly noisy. If there's one or two things, major indicators that we should focus on next year when it comes to informing our investing strategy, what would they be?
It's really got to be the expectations around inflation. So that is the thing. It's always been the view of this year that you're getting inflation back down towards central banks' targets. And it has moved an incredibly long way, right? Inflation's come down a long way. It's just proving to be really sticky to get it back down to under 3% in Australia or closer to 2% in the US. So it's about that inflation expectations. If they start to rise and people start to think we're in an environment where inflation's not going to go away, central banks are going to start to recalibrate. And then that's going to have a knock-on effect to the economy. So, our view is that the growth is there, that, even in Australia, we're getting moderate growth next year. It's a little bit below trend, but it's still positive and you'll get a bit of uplift. US is probably going to get a bit of a boost because of the policy changes to growth. That's all really good. Thinking about investing in risk assets, it's that inflationary side in terms of too much inflation hits the fixed income market or starts to worry about who has pricing power on the equity side of things. So it's really those inflation expectations which will drive a lot of it for us. And if you see those start to creep up, central banks will start to respond.
So, Kerry, one other question that we want to focus on the short term before we turn to the long-term capital market assumptions, it's a little bit more stock specific. Really, the investing life, in Bryce and my investing lifetime, really, well, in the lifetime of Equity Mates, it has been US mega cap stocks. And you can't go wrong if you bought the Mag 7. In fact, if you're an active manager trying to beat the Mag 7, you had your work cut out for you. How do you see that story playing out 2025 and 2026? Is it is it still a story of these mega cap tech stocks driving the market and driving investors' portfolios, or do you see a bit of a rotation coming?
There's a bit of a rotation coming, but I tend to agree. It's very difficult to create a case for saying go underweight these companies. I mean, ultimately, you could obviously, if you've been benefiting from them and you've seen the run up, you can take a little bit of profits to reallocate elsewhere in the market where valuations are better. There's nothing wrong with that, but I don't think you'd go to the extreme point. And I bet there's a lot of investors across our company on the equity side who have done this. They wouldn't go underweight because there's such a strong story there. These companies are producing the earnings that justify those valuations to a certain extent. They're higher margin companies. They should command those higher valuations. They have a huge amount of cash, which means that they're defensive in terms of being sensitive to the changes in the economy. So they're almost becoming not cyclical to the economy to a certain extent. And they're probably going to benefit from some of the changes that come through in terms of how important they are to the economy, protection of production of semiconductors or other technology stocks that are going to benefit from the whole AI theme. So we think about the fact that they have become a big weight within the index, but they're also a big weight within the earnings part of the market. They're also about a comparable weight in R&D and the investment that's coming through. So this isn't like a 2000s tech bubble story. This isn't the same as that. There's genuine momentum behind and quality behind these companies. Should you take that money, a little bit of it, look at the rest of the market? Absolutely. So if we think about better growth coming through, you can think about the AI supply chain, how that impacts, not just producers of the chips, not just the sort of hyperscalers, cloud computers, but you can think about the companies that are going to start to benefit from it, what we're already hearing. So, sometimes that's financial companies that are coming through. You can also see how that's benefiting utilities because providing water and energy, or the people building the data centers, or even the people that build the components that go into housing racks that these computers sit in. So it will feed through to the rest of the economy. So I think there is opportunities. And if we look at the earnings expectation outlook around the companies, the other 493 companies out there, or even 484 if you want to take Tesla out of the equation, those are the ones where you see the earnings growth really coming back into positive territory. The year-on-year comparables are also very good on earnings because you think about 12 months ago, that's when those companies were very much off the low of their earnings. So you'll see that better balance coming in the earnings growth outlook. Those valuations being better elsewhere in the market, I think will drive a little bit of that. So you'll get that rotation, which holds up equities overall. So there's definitely opportunities for thinking about diversifying within the US market, even if people are concerned about diversifying outside of the US at the moment.
So, Kerry, that's the short term, but we want to turn to the long term. You've just released your 29th edition of the long-term capital markets assumptions, which is projections over the next 10 to 15 years. Before we get into some of the key themes, how accurate have you actually been over the last sort of 29 years?
I'm always right. That's the answer. I am 100% right all the time, as I tell myself. No, these projections are done. There's like 60 people involved across asset management and our wealth management business. So it's all the different investment desks. It's all the different strategy teams that we have that input into this. So it is something that draws on like the economic might in terms of thinking about the intellectual capital of JPMorgan to drive these forecasts. And they are used internally as well. So it's not just something we produce for clients. We use these numbers when building strategic asset allocation. And if we look back across the fact that we have done this for 29 years and we're forecasting forward a decade or so, we can then go back and say how accurate we were over those first periods. And so based on that, we've actually been within half a standard deviation of the actual lived experience for our returns based on what we projected. So we have fairly good confidence that these numbers do stack up. Yeah, there's outliers. 2008 was very different, for example, or the debt crisis in 2012 in Europe, the numbers didn't quite match up. But by and large, outside of those extreme events, you actually see these numbers looking very robust in terms of the bottom-up process and the top-down process we use to generate them, and very transferable process, and also just the fact that this methodology has been time and time again tested over the last 30 years to really drive these returns.
So, Kerry, we want to dig into some key themes, but you've just presented some of your findings, and we were in the room, and my big takeaway, and I want you to tell me if this is a fair takeaway, you had a lot of comparisons to your projections from last year, and my big takeaway was the economy has got marginally better. Like everything seems to just be a little bit rosier, like forecasts are a little bit higher and the consumer seems to be doing a little bit better, and that everything just seemed a little bit more positive than where it was last year. Is that a fair takeaway?
Yeah, I mean, we do this year-on-year comparison. Like, what do we think last year compared to this year? It's also important to look across what's the trends that are happening over multi-years for thinking about how we forecast that forward. So when we look at our growth and inflation forecasts for developed markets, they have been moving higher. What drives that over the last year, though, is capital investment. So we've seen companies really shifting in terms of wanting to invest in terms of maybe it's that AI technology theme, maybe just seeing better demand. That's a really different position than what we've been in. That shift in governments to do fiscal activism, like spending money to build that infrastructure that's been underinvested in, to think about the need for defense. It could be not just physical armaments, cybersecurity, all those things that have changed in the last few years. The investment in greener economies as well. That's driving a lot more government spending, and that by and large creates supply. Does create demand as well, so it can have some inflationary consequences, but it creates supply, increases productivity in economies, and drives that growth. And then on top of that, we do have that view around how much technology adoption and artificial intelligence is going to benefit companies, and that again, adds from growth. And I think that that's the trend that's the most important over the last few years, that is really driving a better growth outlook for many developed markets. After coming from a period where growth was always heading the wrong way, demographics were always a headwind, migration was going the wrong way. And then suddenly there's these things that are supporting growth. I mean, there's a couple of things I would mention. Obviously, we're seeing more fractured global economies. That's going to be a bit of a headwind when we think about inflation volatility. And we're also thinking about just that shift in terms of how governments can get it wrong in terms of their spending, that they maybe just create too much demand, and that can have inflationary consequences. So it's not just about a rosier growth outlook, it's about a solid foundation for growth, but also with that comes a bit more inflation and more uncertainty around the inflation. And how do you protect that for a portfolio? 2022, exactly what happened, right? People were like, I had no protection from fixed income. So it's really how you build a robust portfolio for an environment where we have stronger growth, but more inflation uncertainty.
So, Kerry, you mentioned in the short term, inflation was probably the number one thing to keep an eye on. But one of the key themes for the long term is also inflation and interest rates. What's your view on the longer term when it comes to inflation and interest rates?
Two things. The first one is that cash rates can be lower than we are today. So, don't invest in cash. It's not really going to help you out. Higher rates have been great when you're thinking about, there's some of the issues in the bond market. You want a defensive asset class, just does not build wealth in the long run. So cash rates, even though we have them higher this time around, because we think of that shift from the need to have zero rates, the need to have use of balance sheet under fixed policies fading away as we have that sort of higher inflation view and more fiscal spend, government's doing more of the work, central banks have to do less, then we do get a bit more cash rates that are going up. That's actually beneficial when you think about what's the starting block for many assets that have higher cash rates. So yields go up on bonds, which is good, get fixed income, get returns in terms of income coming through, get that cushioning effect from yields that can fall in that environment and create diversification. Also feeds through in terms of thinking about hedge funds. They have a big chunk of cash that uses collateral. They get better returns from that, and they can also think about how that works as a diversifier within a portfolio. So inflation's a little bit up, cash rates go up, but they're still expected to be a long time down from where they are today. And that is going to have knock-on effects in terms of how we think about other asset classes performing. But it does mean that, again, it's more about governments and less about central banks that are going to drive the agenda in the years ahead.
I just want to make a note, Kerry, that for people who maybe feel like this is a pretty jargon-heavy episode, we're going to close this conversation by asking you to translate it into how it should fit into an investor's portfolio. So stick with us because I think there's heaps of interesting stuff here, but we are going to close with making it quite practical.
No pressure.
So one point that you made that I saw Bryce nodding furiously at was the opportunities in private markets. Bryce has been a big lamenter of the inaccessibility of private markets for retail investors. But I found it interesting because there's been a fair bit of reporting this year that a lot of the large endowments have massively underperformed the market because of their bigger exposure to private markets and because public markets have just ripped over the past year. But you think over the long term, private markets will continue to outperform. So can you add some color to that?
Yeah, I think the real key here is that how do you take advantage of the opportunities that are out there without paying too much for them? Or how do you think about balancing out a portfolio in terms of the risks? And private markets do a lot of that. So think about that whole discussion around technology and AI. So that's great. The weight with technology stocks in the US market is very high. The valuations are also very high. Now, we think that's appropriate, but if you're wanting to get into that, is it better to do it through the public or private format? Because that weight of technology sector within private equity is even bigger. A lot of the new companies that are going to take advantage of this are going to be venture capital companies. That's where you get that growth because we do know that companies are either being taken private or they're staying private for an increased amount of time. So by the time they become public companies, the value has been created. And if you aren't an investor who can go into private markets, you can't take advantage of that. So that's the benefit on that side. You're going to cut me off.
There are some pretty front of mind case studies that would contradict what you've just said there about the value being created in private markets. I mean, Nvidia being the most obvious example.
That's true. That is a very unique case that's come through. I mean, I don't know if I'd say case study is one company. But I think that if you look by and large, all those companies are staying private for longer. You do get more of that run up in venture capital companies. You can look back across history and just say, what are the top companies that are in the public markets now that were in the public markets a few decades ago? They do shift. They're companies that come up from nowhere, like Nvidia. And how do you get access to that? Because Nvidia at one point was a private company before it became a public company. So you can have that benefit, but I think it's more a case of saying, how do I diversify into other parts of the market that I grow it? So private equity is just one example of how you can take advantage of growth and think about beating markets. I think for us, it's more around how do you protect against some of those shocks around inflation. Bonds don't do that, right? They get eaten up by inflation. It's a fixed interest asset, as they call it. Inflation, high rates, the enemy of fixed income. What assets do well at inflationary? Yeah, equities, because you can pass on some of the costs. So you do get that benefit. But it is really things that have the ability to pass on those costs more quickly. It's infrastructure companies that have that unsensitive nature towards the economic cycle. It is things like regulated utilities that pass on those inflation costs quite directly, and they can do so. It is things about transport, for example, which pay out huge amount of income, again, not sensitive to the economy and consistently do that regardless of where rates are. So it's how you protect yourself against some of those uncertainties around inflation that really drive that idea of being to private markets and improving that risk-adjusted return. Don't just look at the return overall. Don't just think about what's that number that I want to get. How much risk are you taking for that? Like, how much do you have to sell yourself into buying these higher assets and adding that risk when you're really thinking about how do I protect myself against some of those shocks and how do I improve that risk-adjusted return? Ask any portfolio manager what they look at. It's the Sharpe ratios. They're not looking at total returns. They're thinking about what's my risk-adjusted return. By all means, if you want to take on lots of risk, you can do that, but it just exposes yourself to some of that downside. And we would just say, we've lived through experiences where inflation has been very high. We expect that to happen again more frequently in the future. And so you need to have that protection in your portfolio.
Mm. So the report identifies as well that there's a generational opportunity in global real estate.
Which generation?
Good question.
I would argue there's been a generation that's already had that opportunity.
So
we're not talking about Australian residential real estate. We're talking about global real estate.
Another generation who would disagree very heavily that is the case. Yeah.
Yeah. So where are you seeing this? Any specific types of property? Obviously outside of Australian residential.
It's mainly in the US, right? So just think about the whole shift and what happened after the pandemic. Office space, the values of those the properties just fell significantly, had that oversupply. That's starting to correct itself. So you've seen some of those conversions come through. You've seen prices really adjust. You already saw it happen through the public markets in terms of REITs because they can move really quickly and reprice. It's taken longer to come through on the private side. And so that's really that markdown of those valuations on those assets really creates that huge long run potential that comes up. And that's, some of the numbers in our report this year are the highest in that space. It's more of a US and European phenomenon. You don't see it so much across the APAC numbers because you haven't had that same environment, but it does create the potential for that to be something that can generate a lot of return in assets. Are we calling the bottom in the market? No. You're saying that there's something that's going to maybe manifest itself over the next 12 months and creates that opportunity. But by and large, again, our real estate investors can go out and buy buildings in the US for less than it costs to actually build them, right? That's a pretty market thing that you don't see all the time.
Nice. Just need enough capital to go and buy a building.
Oh, you guys don't have buildings? You don't have like Equity Mates HQ down the
you should
road?
see
I've seen
Instagram,
it.
actually. We're doing a series, Skyscraper versus Australian residential property.
A skyscraper v Sydney,
v
right?
Sydney, yeah.
Which is more expensive, the Burj Khalifa or, a house in Mossman Bay?
Yeah, exactly. There was a 4-beddy house in Coogee that sold for like $5.5 million, and then there was a this largest office tower in St. Louis, Missouri, that sold
Quality.
in Australian dollars, 5.1 million.
But you're making this case for me. The once in a generational opportunity is right there. Promise you can't live in the skyscraper. Yeah.
One fact or one long-term assumption that really caught my eye and I found quite interesting was the impact of artificial intelligence, because we talk about it from a stock market perspective and we see the run-up in valuations and the run-up in share prices of some of these AI-exposed stocks. But you and the team looked at it from an economic lens and how much AI will add to GDP. And for me, it was surprisingly low. It was 20 basis points.
It's just the idea. It's a really conservative estimate. We're very much aware of that. So, and it's important for the numbers that we generate because we take growth and inflation at nominal growth rate is what drives returns and revenues, for example. So those numbers feed through to all our asset returns. The way we look at technology and AI adoption is saying, we have this thing that's going to be impacting the economy. We just don't know when. So we look back and say, look look at when the motor car was invented, and then look when you got the boost in productivity. There was, decades before it happened. And then we go, well, look when the personal computer was invented, and when did you get the productivity enhancement from that? It was still like 15 or so years. This time around, it's like, well, AI is like everywhere, right? I could I could go into ChatGPT on my phone and say, when is AI going to hit productivity? And it will give me an answer. Like the accessibility of this thing is what makes it so uncertain around everyone has access to it. The applications are so wide. It should come through much quicker, but perhaps it's not going to be reflected in the economy as fast as we think. Certainly be reflected in equity markets. So it's a case of we're going to be conservative because we're not sure, even in our 10 to 15 year horizon, when it's going to have the most beneficial impact to the economy. It could be in year 10, could be in year 3. So that's why we're conservative on estimates. So 20 basis points to growth. That's 20 basis points to growth every year for the next decade, though, versus some of the other academic studies that are out there that say it could be a 3 percentage point increase to growth over a decade as well. So I think it's something that just creates massive upside to our forecasts, something that could really address low productivity levels, particularly in Australia, address some of that higher inflation narrative we have, and then create quite a boost in terms of thinking about the long run view for assets and for growth around the world in terms of it. But we wait and see. We don't want to be like over egging that and then having to reduce it in the years to come because we haven't seen it. We'd prefer to be on the conservative side.
Well, the final key thematic is obviously growth projections. Love to get your views on a summary of stock market projections over the next 15 years, and particularly which ones are going to be the best performing.
I mean, we do this process. It's all about focusing on the fact that we are starting from a point of higher valuations. So that does create a drag. You look at the multiples on the US and how much you're paying for them. They're high. Valuations don't do a lot in the short term over 1 year, but they do a lot over 10 years. So that does detract from your return potential for places like the US. It just balances it out, though, against what we're seeing in other markets. So if you're an Aussie dollar-based investor, our return projections for Japan and for Europe are higher because you're getting the kicker from the currency as well, whereas in the US, it's not the case. Also, between emerging and developed markets, that space is narrowing. Now, that does have a lot to do with China and the view on China, but it just says if you go into emerging markets, it's not just simply growth you're looking for. If you put more alpha, you have to be a bit more nuanced. Is it India? Is it Taiwan? Is it Korea? It's not just saying, I'll just add emerging markets. You really want to be aware of their heterogeneous nature. So for us, global equities do play out over the long term. It's not just the US, that's still strong, but look towards Europe, look towards Japan. Corporate governance in Japan, very long run story that's playing through. So that's a little bit challenging in the near term view. If you think about next 12 months, we're all looking at US exceptionalism, American first policies. But if you're setting that agenda for investment for like 3, 5, 7 years, which a lot of people do, they should be making sure they're not underweighting too much the rest of the world when it comes to the equity market.
So, Kerry, I'm just going to give people some of the numbers that I wrote down just so people have them. You had Japan as the highest projected returning stock market over the next, are we saying 10 years here or 15 years?
Technically 12 and a half, and that's in Aussie dollar returns, right?
Yeah.
So we've got to take into account the movement in the currency.
Yeah, so Japan, 8.8% a year. Europe coming in second, 8.3% a year. Australia, a respectable third, bronze medal, 7.7% a year. Dividends. China, 7.4% a year. US large cap, 6.5% a year. And then this one surprised me, India, 6.3% a year. And we did ask you about that during the presentation, and you said it was largely just because of the valuation of the Indian market.
Yeah, coming from a very high starting point. And just on those numbers, those are just a market return, right? Yeah. So we're just projecting that has no account for thinking about how active you can be, who you select as your manager, or how you approach that market. All has the potential to boost those returns markedly. So being active in that alpha generation is something that we would say is why these numbers, they're lower than last year, but can be enhanced on massively.
Nothing wrong with 8.8 for 15 years, though.
I'll take it.
Yeah.
Yeah.
So, Kerry, we said a bit earlier that we're going to ask you how this translates into a portfolio, and you obviously speak to some of the biggest institutions in the world. We don't want that portfolio. How does this translate into a retail investor's portfolio?
What it really does for me is thinking about where you go around the world for that return. So some of those numbers you read out there, Japan, it's Europe, even Australia, obviously it's income. They're dividend players, right? So dividends is a big component of that. You're seeing buybacks increase in the European and Japanese market. So that's, again, a way of companies paying back income to shareholders. So That's great. US is more a growth story. That's where you're getting the growth. And I think the big thing with the US is that even though we have that high valuation starting point, the fundamentally quality nature of that is saying that, wow, you're still getting 6.5% on an Aussie dollar from the US market, even though you're starting at that high point and there's that concern about concentration. That's remarkable. So you can still see ample growth around the world from those asset classes. And then you compare that to Australia. Still really good, 7.7, but that gap between Australia and the rest of the world has narrowed. So really that global focus pays off. So again, the message in terms of portfolio construction is that equity story is fundamentally still quite good. You can balance out that risk now with bonds because they do pay you income and they provide that cushion. They won't protect you against inflation. So that's where you look towards private markets and accessing them through different strategies to try and hedge that off. And I understand that is definitely a challenge for retail investors, given liquidity concerns or just the access. But even there, it's improving. You're seeing more evergreen strategies, as they call them, just means that you can get monthly liquidity and access to these things. You're seeing the buy-in or the amount of money you need to allocate coming down. So they are definitely becoming more retail friendly. And 100% that'll be the way that these asset classes move in the coming years. So I think that access and those alternative assets will become easier for retail investors to access.
So can I just sum up some of the key takeaways for retail investors then? Be globally diversified because you don't know, well, you can't be, the next leg of growth won't be the same as the last leg of growth. Be diversified across asset classes and more we can access those asset classes through, these days, mainly through ASX listed ETFs, you can get every geography in most asset classes, which is great. But then when you're diversifying across asset classes, be mindful about which asset classes will perform well in an inflationary environment.
Absolutely, because that's the thing, that there's been more inflation than we've liked, and that's likely to come down a little bit in the short term, but you're going to go through periods of that inflation number just goes back up, unfortunately, and you have that experience of 2022 and that volatility, and that's the way we see the world going.
Well, Kerry, that brings us to the end of our discussion today. We're certainly looking forward to seeing how this plays out over the next 12 months in the 30th edition.
Oh, yeah. Are you going to come back in 10 years
party,
and tell me I was wrong?
Party. No, we'll never tell you you're wrong. You're always right. So we want to say...
We're looking forward to the Black Tie Gala for the 30th.
Yeah. I get told I'm right all the time by people. It's a constant thing I hear, just like, man, that guy's right all the time. It's just, phenomenal. Yeah.
So we want to say a big thank you to you, but also a massive thank you to JPMorgan Asset Management for the continued support for Equity Mates this year, and we really appreciate what you guys are doing in the space, bringing a lot of your products to market now through those low-cost active ETFs, which we've done some content on. If you're interested, go to our Get Started Investing feed, and you'll find some deep dives on the ETFs there. But thank you, Kerry. As always, it's a pleasure. We really appreciate your time.
Thank you very much, both of you.
Thanks, Kerry.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.